Doing these deals with bonds, they could provide up to 90% of cost. So meaning we may have to raise some capital on the back end of this to close that equity gap. So let's just use $100 as an example. These bonds, we'd have $100 worth of bonds issued. Publicly traded company comes in and says, we'll buy these bonds up to 90% LTC. So they'll have three tranches of bonds. A bonds would probably total somewhere around the 89, 88% LTC. Then you've got a small piece that's in the B tranche. That's your taxable tail. That taxable tail pays for the cost of issuance and et cetera. So typically your A buyer buys the A's and the B's. And then that C tranche of bonds is where the equity investors' money would go. So they would actually become debt holders versus being in a syndicated type transaction. And they're paid out as the senior debt is paid. So every 6 months, there's a debt service payment made.